Welcome back. You're still tuned in to Closing Bell on CNBC-TV18. We're tracking the last 1 hour of trade, and there are several pockets that are doing well. The pocket that stands out right now is real estate. Brigade Enterprises is up almost about 5-odd%, but the others are not too far behind. So whether it's DLF, Oberoi Realty, macro tech developers Lodha, Godrej are all in the green. In fact, Oberoi Realty comes out with its earnings as well on 14th. That's on Friday. So ahead of that, the street is quite excited. Dinshaw Irani, the Chief Investment Officer at Helios, joins us now to talk about this and other topics. Dinshaw, thanks a lot for joining in. Since we're talking about real estate, right? I mean, DLF is in focus. I understand that its recent project in Gurugram sold all their 300 luxury homes in one shot for over 1,800 crores. That's the kind of momentum that we're seeing in this market, in the real estate space. Are you just buying stocks, or are you also buying homes?
So that's a good question, Sonia. Thank you for having me on your show, and a good afternoon to your viewers and your team as well. But the fact is that, Sonia, you've seen what's happening globally, right? I mean, the Hang Seng has touched levels of 2009, last seen in 2009. Nasdaq is at 2-year lows. S&P is almost 2-year lows as such. So it's obvious that India has been an island in a sea of red, and rightly so also to an extent, because given the inherent strength of our country, I mean, the fact that we're going to be the fastest growing economy for the next 3-4 years is such, driven by consumption, domestic consumption and outsourcing. And secondly, don't forget our base of investors. I mean, the DIs have more than absorbed the kind of selling that the FIs have put onto India as such. So that has helped us to outperform to a great extent various markets and regions in particular itself. But that also has made us more expensive vis-a-vis the region, right? Because the region has corrected and we haven't as such. So it's becoming a stretch. And that, I mean, that is what our worry is, that you can only swim to that extent against the tide. Ultimately, you will also go with the flow. So for our markets to continue to perform handsomely, I think the region, or probably the developed markets, have to even out to an extent, which today doesn't look that good a picture. I mean, we basically looking at probably this quarter or the next quarter, things becoming more clearer as compared to the DMs, how they manage this kind of inflation and how they pan out on the recession front as such. The base case today is a limited recession. And beyond that, I'm sure there'll be a problem with all markets put together, India included as such. So the next 2 quarters are very crucial. Our call is that more or less the markets will even out of this on this basis. I mean, there'll be probably a time correction going forward, and you'll see some ups and downs, but mainly it'll be in a band that we'll be working in. So we're working with that scenario today, Sonia.
Dinshaw, hi, afternoon. Prashant here. In terms of, so we got the mutual fund flow number, right, for last month. Right. The SIP figures are steady. They even rose a little bit as compared to the prior month. True. There were a lot of NFOs, etc. But what you basically describe as ex-NFO, ex-SIP, I mean, if you want to take a look at that number, that the discretionary flow, that has been negative for more than a few months. What are you seeing? Is money still coming in into equity products? And yeah, go on then, Dinshaw.
Yeah, so Prashant, basically, I mean, looking at the flows that we are seeing today, I mean, I'm talking about Helios in particular. We run a PMS and an AIF. AIF is always a close-end product. But the PMS, we see regular flows, inflows coming in, yeah. But again, I mean, I'm sure this is mainly, I mean, you talked about the September numbers. In fact, a mild correction in September saw the figures for mutual funds just shoot up by 2,000, 3,000 odd crores in that particular month. So the retail participation has been very good, but as gatekeepers to their investments, we have to be very clear that we have to be a bit more cautious to that extent. So what we are telling our investors is that though you want to invest, but we want to stagger it for you. So we put it in a STP kind of a product, and we're evening that out. So I think that basically India hasn't seen a big correction, right? So I think the new investors who are coming in, they've seen only upsides from here on a flattish market, but we got to educate them. And that's why we believe that it's better to be cautious today, probably stagger your investments over a period of time than be aggressive. So flows haven't been impacted to that extent, I believe.
That's interesting. So you're holding more cash and kind of staggering it out as you get it to match that view that you know, eventually the direction will be the same. The intensity may be different.
So basically, for India to grow, I think the world has to even out. Right? World has to flatten out. If they keep falling like this on a daily basis, ultimately India will also be correcting to that extent, because you can't have too much of a runaway gap in your valuation vis-a-vis the global markets.
So you can swim against the time only for a limited amount of time and for a limited distance. And Dinshaw, just to add to that point, you know, MSCI India's valuation premium over MSCI emerging market historically used to be about 60-65%. Now, given the underperformance of MSCI emerging markets vis-a-vis India, because most of those markets are down 25-30% on a year-to-date basis, that premium of MSCI India versus over MSCI emerging market has now shot up to 140%. And just to add to the point that, you know, you were talking about how long can that sustain. But, you know, one place where investors have sought shelter has been banking. And the numbers are also looking good. The business updates for most of the banking, you know, for most of the banking names that have come out so far indicate that the loan growth is going to pick up 4 to 8% on a quarter-on-quarter basis. But, you know, everyone's expecting blockbuster numbers, and in a way, then it gets priced in. So what's the scope for an outperformance of banks from here on?
So, Reema, good question as such, because we are also very bullish on that particular sector. So what we did was that in order to insulate ourselves from the global events that are happening, we went very, in fact, we sold off the whole of IT to that extent, and that's around 13-14% of the portfolio. In August itself, we sold it off, and we said we don't want to be in any sector which is external facing and may get impacted by the recession and DMs and such. So that's what we did. And where did we deploy that money? Because we didn't want to keep that much cash lying with us. So we started deploying it in private sector banks and NBFCs to that extent. But mainly the call here was that we are looking at interest rates moving up, right? I mean, that's a given. In fact, US, which was supposed to end the year at something like 3 odd, rather, when they started off, it was 2.25%. And today they're talking about almost 4.25% as ending the year at, right? So given that fact, given that background, we are also very clear that in a rising interest rate scenario, is the consumer-facing banks which really prosper, because the NIMs start expanding to that extent. I mean, they do not, the borrowing cost moves up gradually, but the lending cost straight away shoots up, right? So that's why the NIMs expand. And that's where we've been investing. And frankly, as I said in the beginning, if you're talking about a consumption-driven economy, it has to be driven by banks which are consumer-facing banks, which is going to fund that consumption. So that's what our call has been. Apart from that, we also got into what we identified way back in April as such a theme which we called as affordable luxury, or rather mass luxury segment. I think that's another theme where we're adding to our positions as such, and that's also played out to that extent.
Okay, we do know your view, at least your house view on the auto sector. I mean, we've spoken to Samir at length, and he's always told us that he's not very bullish. He believes, you know, the end of this year will be less than sales last year. But things are changing, right, Dinshaw? I mean, there's so much disruption happening here. Players like M&M are now leading from the front. There's so much happening in the two-wheeler space. At any point, would you change your view on the auto sector? Would you look to buy any stocks?
So Sonia, I mean, it's akin to what telecom went through earlier. I mean, I'm talking about in 2013-14 when Reliance Jio came into play, right? So there won't be any winners, frankly. I mean, when EV space comes, so right now they're all earning out of the fact that you know, the commodity prices have come off. There's a pent-up demand. The Diwali sales has been fairly good, and the festive season sales are supposed to be good, right? But look at the longer trend. What are we talking about in the future? We're talking about a huge disruption happening here. I mean, I remember coming to your channel probably a year back and saying that the world has anointed Elon Musk as the next disruptor, which became the richest person in the world. And that you've seen what the earlier disruptors were like. I mean, who were the richest people there. So basically, the EV space is going to be a disruptive space. there won't be any winners in this space, because look at the kind of capexes we're talking about, and then compare it to the capexes that our homegrown companies are talking about. It's nothing as compared to what they're saying. So it's gonna be a pretty messy space going forward. So that's why we're avoiding this. You already seen it in the two-wheeler space. EVs have created quite a disruption. In fact, the festive season has been fairly dull for the two-wheeler space. So it's better to be away from an industry which is going to be disrupted in the future, and stay away. And probably you'll, as we tell our investors, that there's enough fish in the pond for us to fish. You don't have to be in something which is moving for a momentum as such right now.
Hilsa, Pomfrey, Surmai.
I'm getting hungry.
Dinshaw, so name a few fish for us. I mean, anything new which has fallen into your net? I mean,
I like Atlantic salmon, by the way. So.
I think they're taxing salmon fishing quite aggressively now. I read somewhere that that it's going to be tougher to find them.
Yeah, that could be lucrative. But anyway, so what we did, Prashant, was we added a few new names to our portfolio, mainly in the mid-cap banking, private sector banking space. And they were mainly companies which were, one was a regional focus private sector bank, which is into micro lending as such, and the other one is fairly aggressive. I mean, it's not a new name, but it's been around for a while, but still has done fairly well, even in the upheaval of its times, and that corrected to that extent because of the problems that we're seeing. And we added those two names, and that's about it in that space. So.
Indecent, Dinshaw?
Sorry?
One of them Indecent?
Indecent was added much earlier. Okay. It was added much earlier, but there are two other new names which we added. But I won't tell you.
So in this affordable mass luxury theme, which you've identified in April, some of the names which you've spoken about in the past include Vedant Fashion, Westlife, PVR, Campus Active Footwear. Any other new names in this theme?
Not really, Reema, because there's been a dearth of names in this space, so we've been adding to this particular. So basically, I think Titan is one more name which is there in that space, which has done fairly well as such for us. So we added to that name too in the past. But apart from that, there's not many names that we can put about here.
Luxury is doing just fine, by the way, Reema.
Yeah.
I was Louis Vuitton CEO. They just reported numbers. They said. They reported, by the way, super strong numbers, right? Because, I mean, it was the quarter when Americans could step out for the first time, travel to Europe, stronger dollar. So and
it's cheaper for them, right? The minute a US American goes to Europe and he goes to France and he buys an LV, it's much cheaper. He's getting a straightaway discount of 10-15% based on the depreciation.
But the CEO said luxury is not a proxy for the overall economy. So I found it interesting. But luxury is what is doing well around the world. And I think we've discussed that many times here. Sonia, you want to make a point?
You know, I was talking about it earlier, right? When I asked Dinshaw if he's buying homes. I mean, DLF India Panchkula property sold all their luxury homes, 293 homes, for a sum of 1,800 crores. You're talking about a Louis Vuitton bag. It doesn't cut it. I mean, people are buying 20, 30 crore homes just like it's, buying vegetables in the market.
But at some point, I guess the COVID-related savings will run out, right? I mean, we've seen this big surge in buying in the last 2 years because a lot of people didn't get to spend it in 2020, 2021. But at some point, it's going to run out. And there was some survey I read very recently, perhaps in the last 2 weeks or something, which said that for the first time, household savings has dropped to what it compared to pre-COVID levels, right?
No, savings have dropped.
At some point, it's got to stop, right?
I put that to Pavitra Shankar of Brigade, who was with us. Everyone was locked in for 2 years. And so she said, well, what has happened is that people's outlook on life has changed, right? What is important, how much space you need. People have had time to reflect on those things. So maybe the momentum fizzles out a little bit, but the runway for growth for housing, etc., is quite long.
All companies are calling their employees back to office. There was a headline in the paper yesterday or today saying that if you want to work from home, show us a medical certificate.
But why do you want to work from home?
I'm not saying that. I'm just saying that.
If I may add to that argument.
Go on, Dinshaw.
Yeah. So I recently read that, brands like Rolex or Patek Philippe or Odema Pigue, they have run out of stocks.
Yeah.
Okay?
Yeah,
So that's
yeah.
the kind of talk we're talking about. And secondly, it stands to the argument that can be in favor also is that the concentration of wealth has increased quite a bit as compared to in the past, right? So another argument that we have come across is that this time around, the US may not have to increase the interest rates that much to start impacting the demand, because the bulk of the households are already feeling that pinch to that extent, because, as I said, the savings are concentrated in the hands of a few, right? So that if that plays out, that's why our base case argument here is going to be that only, that we to look at a limited kind of a recession in the US, and then probably things will start evening out. That's why the next 2 quarters are fairly crucial.
No, absolutely. Dinshaw, it's something which needs to be watched carefully. Thanks very much for joining us, Dinshaw. Appreciate you joining in with that perspective today. 130 points, by the way.
Pleasure.
On the index, 17,113 is where we are at. We'll take that quick commercial break. We're back with what is happening in dealing rooms. Nimesh joins in for that. D Street Chatter. And of course, we'll also run you through some trading ideas.